Brad Williams, Frugal Finance, forward price, not forward contract this time. Forward price, a generalization. Forward price is like predicting the future costs of something. In this case, a stock. Let's break it down. What are we doing? Imagine you're planning to buy something, let's say a stock in the future, but you want to know how much it will cost now to buy it later. This is where forward prices come in. So do options. We'll focus just on forwards, and then eventually we'll get to options. The formula they've given might look like a bunch of letters and symbols jumbled together, but it's basically saying forward price is equal to current stock price minus present value of future income times whatever compounding there is. This EXP, rate of return times time, all that is the compounding effect. In simpler terms, it's like this. You take the current price of the stock, then you subtract the value of any future income you expect to get from owning that stock. You adjust this by how much money you could make by investing your money somewhere else, the rate of return, over the time until you buy the stock. This gives you the forward price, which is what you should be willing to pay now to buy the stock later. In other words, say you're thinking about buying a stock in 10 months. And right now it costs $50 per share. But you know you'll get some dividends income from owning that stock before you buy it. The total value of those dividends adjusted for time and interest is about $2.16. Using the formula, you find that the forward price of the stock is around $51.41. Why? Because eventually you're going to get this $2.16, but we need to discount that back. So let's see what we're doing here. Now, if the forward price is less than this, smart investors might want to sell the stock now and buy it back later at the lower forward price. If it's more, they might want to do the opposite, buy the stock now and sell it later at the higher forward price. This is called arbitrage, where people make money by taking advantage of difference in prices. They should say where people make riskless money. It's free. Okay, there's zero risk here. Now, we can generalize from the other examples. When an investment asset will provide income with a present value of I during the life of forward contract, we have, this looks really familiar, doesn't it? F of O is equal S minus L times EXPR times T. In our example, S is equal to 900. I don't think that's supposed to be 900, but this looks like the same example. Maybe this was Berkshire Hathaway 10 years ago, the stock price. I is equal to 40, EXP 34 divided by 12. Okay, we went down this road. This is the exact same example as previous, but it's illustrative. Consider 10-month forward contract on a stock. When the stock price is 50, we assume that the risk-free rate, always keep that in mind, the risk-free rate of interest continuously compounded is 8% per annum for all maturities. We also assume that dividends of, looks like 75 cents per share is expected after 3 months, 6 months, and 9 months. The present value of the dividend is 0.75. Well, this looks really familiar, doesn't it? Go back to section 3, the bootstrapping. Exact same formula. All we're doing is finding the compounding rate. We're going to discount that back. Clearly, 75, and I'm thinking there's 3 periods. 75 would be $2.25. What happens? We discount that back based on this continuous compounding rate to come up with $2.16. The variable T is 10 months, so that the forward price is equal to 50 minus 2162 times EXP 5141. Why? Because there's some assumption about this $50. If the forward price were less than this, an arbitrager would short the stock and buy forward contracts. If the forward price were greater than this, an arbitrager would short forward contracts and buy the stock in the spot market. What I want you to do is think about this and why is an arbitrager shorting the stock and buying forward contracts if the forward price is less than 51.41 and vice versa. Why is arbitrager shorting the forward contract and buying the stock? Let me know. Brad Williams, Frugal Finance. See you soon.